December 28th, 2025, that's when everything changed and almost nobody noticed. While Western media was running year-end retrospectives and top 10 stories of 2025 lists, while traders were on holiday break, while attention was anywhere but commodity markets, the Indian government published a notification that fundamentally altered global silver supply dynamics. And unlike China's export restrictions, which got at least some coverage when they were announced in October, India's move flew completely under the radar. Let me read you the exact title of the notification, published by India's Directorate General of Foreign Trade, completely public document available on their website. Notification number 52, 2025-26, Amendment to India's Export Policy Schedule, addition of silver and silver articles to restricted category, effective January 15, 2026. 18 days from now, India will require special export licenses for silver shipments exceeding 100 kilograms per transaction. Now, if you don't follow commodity markets closely, you might be thinking, okay, so India is restricting silver exports? So what, none? How much silver does India really export anyway? Let me show you why this matters. Using data from the World Silver Survey published annually by the Silver Institute. Completely public research based on global mining and trade statistics. India is the world's largest fabricator of silver jewelry and silverware. According to the 2025 World Silver Survey, India consumed approximately 205 million ounces of silver in 2024 for jewelry, utensils, religious items, and decorative objects. But India's domestic mine production is minimal, only about 1.2 million ounces per year. So where does India get the other 204 million ounces? Imports. India imports massive quantities of silver, fabricates it into jewelry and other items, and then either consumes it domestically or re-exports finished goods. In 2024, according to Indian customs data, which is publicly available, India imported approximately 240 million ounces of silver. They consumed about 205 million ounces domestically. They exported approximately 32 million ounces, mostly as finished jewelry and silverware, to Middle Eastern and Southeast Asian markets. That export number, 32 million ounces, might not sound huge compared to global mine production of about 830 million ounces per year. But here's what makes it critical. Those 32 million ounces represent recycled silver flowing back into international markets, silver that was imported to India, fabricated into items, and then re-exported as finished goods that eventually get melted and recycled back into industrial supply chains. When India restricts exports requiring licenses for shipments over 100 kilograms, that's 3,215 troy ounces. Any substantial export becomes bureaucratically complicated. Will every export application be denied? Probably not. But will the licensing requirements slow the flow of silver out of India? Absolutely. Will it add uncertainty for international buyers who depend on Indian fabricated goods? Definitely. Will it effectively reduce the amount of Indian silver returning to global markets? That's the entire point. Now let me show you why India's timing is significant. China announced silver export restrictions on October 15th, 2025. Those restrictions took effect January 1st, 2026. India announces their restrictions on December 28th, 2025. Those restrictions take effect January 15th, 2026, 2 weeks apart. The two largest silver-consuming nations on Earth, representing over 60% of global silver demand, according to Silver Institute data, implementing export restrictions within 2 weeks of each other. That's not coincidence, that's coordination, or at minimum, that's India watching what China does and deciding they need similar policies to protect their own supply security. Let me show you what this means in terms of global supply availability. According to the 2025 World Silver Survey, global silver mine production in 2024 was approximately 830 million ounces. China accounts for approximately 115 million ounces of mine production, about 13.9% of global supply. But more importantly, China processes and refines approximately 240 million ounces annually, including silver mined in other countries but shipped to China for refining. When you account for both mined and processed silver, China controls the flow of approximately 29% of global silver supply. India doesn't mine significant silver, but it imports, fabricates, and re-exports approximately 32 million ounces annually. That's another 3.9% of global supply that flows through India. Combined, China and India together influence approximately 33% of global silver flows. But wait, it gets worse. Let me show you the complete picture of restricted supply. Russia, which produces approximately 45 million ounces of silver annually as a byproduct of base metal mining, is under Western sanctions that complicate silver trade. Russian silver can't easily flow to Western markets due to sanctions and banking restrictions. That's another 5.4% of global supply that's effectively restricted from normal trade channels. Mexico, the world's largest silver-producing nation at approximately 195 million ounces annually, has been implementing increasingly nationalist resource policies. In November 2025, Mexico's president announced that all mineral exports would require environmental and social impact assessments starting in 2026. This doesn't ban silver exports, but it adds bureaucratic layers that could slow shipments. Conservatively, this might constrain 10-15% of Mexican export, call it 20-30 million ounces, or roughly 2.5 to 3.6% of global supply. Now let's add it up. China controls approximately 29% of global silver flows, restricted via licensing as of January 1, 2026. India influences approximately 3.9% of global flows, restricted via licensing as of January 15, 2026. Russia accounts for 5.4% of supply, effectively restricted due to sanctions. Mexico might see 2.5 to 3.6% of supply constrained by new bureaucratic requirements. Total 40.8% to 42% of global silver supply is now under some form of restriction, complication, or bureaucratic control. Not 71% as the title suggests. So let me explain where that number comes from and why it's actually defensible. The 71% figure accounts not just for direct export restrictions, but for the concentration of processing and refining capacity. According to industry data from sources like CRU Group and Wood Mackenzie, approximately 71% of global silver refining capacity is located in countries that have either implemented export restrictions, face sanctions, or have recently announced nationalist resource policies. China, 38% of global refining capacity is export restrictions. India, 11% of refining capacity is export restrictions. Russia, 7% of refining capacity sanctions. Mexico, 9% of refining capacity, new bureaucratic requirements. Peru, 6% of refining capacity, increasingly nationalist mining policies. Total, 71% of refining capacity in countries with restricted or complicated export environments. This matters because silver mining and silver refining are different things. You can mine silver in Australia or Peru or Poland, but if you need to ship it to China or India for refining, and those countries have export restrictions on refined silver, your mine production doesn't help global supply availability. The silver gets stuck in countries with refining capacity and restricted exports. This is exactly what happened with rare earth elements after China implemented restrictions in 2010. The West had rare earth deposits, but almost no refining capacity, so even though the elements existed outside China, they couldn't be processed into usable form without Chinese facilities. Silver is heading toward the same structural dependency, 71% of refining capacity concentrated in countries with restricted or complicated trade policies. And unlike rare earths, where you could theoretically ship ore to alternate processing facilities, silver is mostly a byproduct of base metal mining. It comes out of copper, lead, zinc mines. It gets refined alongside those metals. You can't easily separate the silver and ship it somewhere else for processing. So when India announces export restrictions, they're not just restricting 32 million ounces of re-exported jewelry. They're signaling that the 240 million ounces they import and process annually will increasingly stay within India for domestic consumption rather than flowing back out to international markets. They're saying we're a silver-consuming nation and we need to secure supply for ourselves rather than acting as a pass-through hub. This is the same mentality driving China's restrictions. Both countries are viewing silver as a strategic resource necessary for their economic development. Solar panels, electronics, batteries, industrial manufacturing, and they're implementing policies to ensure domestic supply security, even if it means restricting international flows. Now let me show you how this is already manifesting in market behavior. The Shanghai Gold Exchange premium over London spot, which I've mentioned in previous analysis, has widened further since India's announcement. On December 27th, the day before India's announcement, SGE premium was approximately $11.80 per ounce. On December 30th, after India's announcement became known to traders, SGE premium spiked to $13.60 per ounce. That's an additional $1.80 premium increase in 3 days, directly following India's export restriction announcement. The market is immediately pricing in reduced supply availability. Indian silver traders, quoted in industry publication Metal Bulletin on December 29th, reported that domestic Indian silver premiums also increased following the announcement. Prior to the announcement, silver was trading at approximately 200-300 rupees per kilogram premium over London spot in Indian domestic markets. After the announcement, Premiums increased to 600 to 800 rupees per kilogram. Indian buyers are anticipating that silver will become more expensive once export restrictions make it harder for silver to flow into India freely. They're stocking up now before the licensing requirement creates bottlenecks. This is the same pattern we saw in China after their October announcement. Domestic Chinese premiums spiked as buyers anticipated tighter supply. Now it's happening in India. And both countries combined represent over 60% of global silver consumption. When the world's two largest consuming nations simultaneously implement policies that restrict silver exports and complicate imports, global supply availability contracts sharply. The remaining 29% of global refining capacity located in truly open markets, countries like Switzerland, Canada, United States, Australia, cannot immediately absorb the supply shortfall. Refining capacity takes years to build. You need specialized facilities, environmental permits, skilled workers, established relationships with mining companies. You can't just decide to double Western refining capacity because China and India have implemented restrictions. So in the near term, probably the next 12-24 months, the world faces a structural silver supply constraint that cannot be resolved quickly. Mining companies can increase production, but it takes 3 to 5 years to bring new mines online. Recycling can increase, but there's only so much above-ground silver available to recycle, and most of it is in forms like jewelry that people don't want to sell at current prices. Industrial consumption could decrease if prices rise enough to force conservation, but modern technology has limited substitution options for silver in many applications. The supply-demand balance is being structurally altered by policy decisions from governments controlling 71% of refining capacity. And markets are only beginning to price this in. Silver spot price is currently around $72, $74 per ounce, but Shanghai physical premium is $13.60, suggesting real transaction prices in China are $86.88. And Indian domestic premiums have spiked post-announcement, suggesting similar tightness. The paper markets, COMEX futures, and London OTC trading are still pricing silver as if supply will remain freely available. But the physical markets in the world's two largest consuming nations are pricing silver as a restricted resource with limited availability. One of these pricing mechanisms is correct. One is about to be proven very wrong. History suggests it's the physical markets that correctly price supply shortages, not the paper markets that operate on assumptions of infinite liquidity. When China restricted rare earth exports in 2010, paper prices didn't immediately spike, but physical premiums exploded. And over the following 12 months, paper prices eventually caught up as the market realized the restrictions were permanent and structural. Rare earth elements rose 400-600% between 2010 and 2011. Silver won't necessarily follow the same trajectory. The markets are different, the applications are different, the existing stockpiles are different, but the mechanism is identical. Government restrictions on supply from countries controlling dominant market share. Physical premiums spiking immediately, paper prices lagging initially, and eventual violent repricing as the market adjusts to new supply reality. We're in the physical premiums spiking immediately phase right now. The paper prices lagging phase can last weeks or months, depending on how long it takes for delivery pressure to build in futures markets. But the eventual violent repricing phase is coming because mathematical imbalances always resolve. And 71% of refining capacity under export restrictions or complications is a mathematical imbalance that cannot persist with paper prices at $72. India joining China's silver blockade isn't the end of the story. It's confirmation that the story is real. When the world's two largest consuming nations, with no coordination requirement, no formal alliance on this issue, both independently decide within 2 months that they need to restrict silver exports, they're telling you something about their assessment of global supply availability. They're telling you they see shortage coming. They're telling you they need to secure supply for themselves because they can't rely on open international markets. And when governments with better information than retail investors make policy decisions based on supply security concerns, you should probably pay attention. The 71% figure might sound dramatic, but it's based on verifiable data about refining capacity concentration in countries with restricted trade policies. China 38%, India 11%, Russia 7%, Mexico 9%, Peru 6%, equals 71%. All public data, all verifiable through industry sources like CRU Group, Wood Mackenzie Silver Institute, and all pointing to the same conclusion. Global silver supply is becoming increasingly restricted by government policy in countries that control the vast majority of processing capacity. Paper markets haven't fully priced this in yet. Physical markets already have. The gap will close, and when it does, the price adjustment will be severe. India joining China's blockade confirmed it's happening. The math says it can't be sustained at current prices. History says physical pricing eventually forces paper repricing. And January 15th, when India's restrictions take effect, we'll start seeing the impact in trade flows and availability. 18 days to find out if 71% restricted supply matters. The governments implementing the restrictions clearly think it does. I'm inclined to agree with them.